All right, so we had a very, very busy earnings week. This week we had 4 of the Mag 7 stocks release, which I'll get into quickly. First things first, as far as the market goes, the S&P was up about 2.5% this week. The NASDAQ was up a little over 4%. So the markets as a whole did pretty good. And I think the reason for that is we've had a good earnings season so far. I mean, Google released very good earnings. Tesla released solid earnings. Microsoft released good earnings. And I think that's what's causing the market to go back up. As far as interest rates go, my opinion is still that I don't think we're raising rates unless inflation ticks up significantly. I don't think that's going to happen for several reasons. Number one, that would be the Fed admitting that they were wrong again. So I think that's something that definitely lowers the chances. And number two, the Fed is at least to some degree politicized, and that would probably put the final nail in the coffin of the Biden administration. And I think number three as well, that would potentially cause significant issues in the banking system as well. So I think that the next move still overwhelmingly likely. I would probably put like an 80-90% chance that the next move will be down. But to be fair, I would probably set the odds at about 50-50 whether the next move, whether we will get a cut within the next calendar year. I think that it's like I say, probably a 50-50 chance whether we get a rate cut this year, because inflation it's looking like, and I think it's very likely that inflation is going to stay very sticky, and that's something that I think is going to be real concerning. Do I think we go back up to 7 or 8%? That's pretty unlikely. But I think that, staying around 3%, 3.5% even, I think that's definitely possible. So that's why I think that it's probably, if I was betting, honestly, I probably would bet on no rate cuts this calendar year if I had to bet. But again, personally, I'd probably still set the odds at 50-50, because if we get any significant problems like in the banking system or anything like that, the Fed's going to have to step in. And again, if we have any major crash or anything like that, even a moderate crash, they're going to cut, right? And again, at the end of the day, the Fed, at the end of the day, most of these guys and girls, they're doves, right? The majority of them are not hawks, they are doves. And over the long run, that probably means cuts are more likely than raises. And another thing to point out too is that, frankly, I don't think, if they raise, they're probably going to raise like 25 basis points. And 25 basis points is not going to make a significant difference. They would have to raise 100, 200 basis points to actually make a difference. And that's not going to happen. And if it does happen, they're going to do it over 6 months to a year probably. So at the end of the day, and not only that, the last thing I'll leave it on here is, I don't think the Fed is as important as people make them out to be. So anyway, that's what I wanted to bring up there. As far as the markets going forward, I think that the next the PCE, which was released this week, is arguably more important than the CPI. But at the end of the day, people still have this psychological thing that they value the CPI more than the PCE, even though the PCE is actually a better gauge, at least in my opinion and from what I've heard in doing my research. So that's something to keep in mind. I think the markets probably stay range bound within the couple percentage, 2 or 3% either direction where they're at right now. I don't think we get a major move either way until something happens with rates. If the Fed's like, if the Fed starts talking super hawkish, that probably means a downturn, especially if that coincides with inflation going up, which it probably will. If it doesn't, then we probably go higher, especially if earnings continue to do well. Bitcoin was down a little bit on the week. Again, a lot of people expected things to just immediately turn extremely bullish after the halving, which probably was unrealistic. I think that, again, if Bitcoin was predictable, then everybody would be making crazy amounts of money in it. And I think that, again, I think we're just in a temporary lull, for lack of a better way of putting it. And a big crash in the market, that probably would bring Bitcoin down significantly, but that would just provide a good buying opportunity. So over the long run, I'm still very bullish. I think that again, we're just in a lull period right now, and I think that over the next 6 months, probably we're going to see another, 2 month period, 3 months period where it's up 50 to 100%. I think that that's more likely than not, at least in my opinion. So first things first here, let's get into the Mag 7 stocks. The first one on the list is Tesla. Now, Tesla did not release very good earnings. They missed on earnings per share and revenue, but they were up very significantly on the week, which again, I think that's just more of a, hey, we're as much of an AI company as we are a car company. And honestly, in my opinion, I don't buy the hype on that. They're up 18% on the week, which is crazy. Although for Tesla, that's not crazy out of the ordinary. I don't buy that hype yet. Number one, because the market does not, I mean, some people do, but the market does not understand just how unprofitable and how competitive the car business is. So the whole point that I would make here is that if the AI hype doesn't come to fruition with Tesla, I think they're worth $40 a share, $50 a share. That might even be too generous. Now, again, if the AI hype comes to fruition, the self-driving, all that stuff, okay, then maybe you can justify the valuation. But, I mean, let's look at what they're valued right now still. I mean, you're looking at a price to free cash flow of 388, a PE of 39, price of sales of 5.6. I mean, it's still too expensive for me. Personally, I wouldn't even be considering Tesla until below $100. I would probably realistically start to buy $70, $80 a share. That's my opinion. So that is Tesla. The next stock we have here was Meta. Now again, Meta, they beat earnings, missed revenue, and they did lower their guidance. So honestly, not the best earnings report for Meta. That's why they were down pretty significantly on the week, although they did trend up a little bit afterwards. I think that, again, Meta was clearly overbought. I think that they were overvalued. They were up massively on the year. Again, they still are below their historical PE and historical price to free cash flow, although I think that those numbers are a little bit too generous in my opinion. Solid company, but I think they're still too generous in my opinion. Google had probably the best earnings of the Mag 7 companies. They released very good earnings. They were up very big on the week. They also announced, again, a share buyback program, and they're going to start paying a dividend, which is exactly what I like to see. That's something that definitely makes me interested in Google. And frankly, I don't think that they're definitely expensive where they're at right now, but honestly, of all the Mag 7 companies, after what we just seen, I think that you could make a really good case that Google is the best one. In my opinion, it comes down to Google, Amazon, and Apple, at least in my opinion. Microsoft's way too expensive. Tesla's way too expensive. Nvidia's way too expensive. And then if you look at Meta, again, still a little too expensive in my opinion there. I think that Google, Amazon, and Apple are the best companies out of those, and I think they have the best moats. Although, again, just my opinion, do your own due diligence. The next one is Microsoft. Microsoft released good earnings. They beat on everything rather easily. So, again, Microsoft, a very good company, but again, they're just too expensive, especially for how big they are. I mean, they're a $3 trillion company. And again, they're trading at a 44 price to free cash flow, a 13 price to sales. Like, if you buy with the current levels of earnings, you're pricing in a crazy amount of growth. And for a company that big, it's hard to continue to grow at the rate that they have been growing at. So it's inevitable that you see diminishing returns with these companies, which is why I don't own any individual shares of any of these companies. I do have a small position in the QQQ and a little bit in an S&P fund, but I wouldn't be buying any of the Mag 7 companies unless you're getting them at a very, very obvious discount. Again, also just my opinion there. So again, getting into some other companies here, Alexandria Real Estate, again, a company I have a very small position in. They did beat earnings, which again is nice. I own this company primarily because of the dividend. Again, 4.37%. They are growing that about 5% per year. Again, you're buying this company because of the dividend. That's about it. BRO is a company I have on the watch list. Again, they are an insurance company. They released very good earnings. So again, I'm probably not going to get a chance to buy this company anytime soon by the looks of things. But again, I think that insurance companies are going to be very good, especially if rates stay where they're at. Insurance companies are going to do very good and continue to do very good. CDNS, and again, another company I have on a watch list. Again, they did beat earnings, although they lowered guidance a little bit. So again, a little bit concerning there. But again, I still think they're a very solid company. EWBC, again, this is East West Bank Corp. Again, I think they're one of the better regional banks. I do have a small position. They did beat earnings per share and revenue. And again, if we look at the dividend on this company, 2.9%, payout ratio of 27%. And again, they're raising that 19% per year, which I think is sustainable, at least for the near term, because again, the payout ratio is very low. The next one here is Freeport-McMoRan. Again, copper has done very, very well recently, hence they beat earnings and revenue. Again, they're over $50 a share. I actually had a very large, I think I probably had a 5 or 6% position in this company. I think the average position was like 38 and a half, and I sold it at like 44, 45, and I'm kind of kicking myself because it's actually up very significant. I mean, if you go year to date, what is this company up year to date? I'd like to know. They're up about 22%, which is easily beating the market. So, and again, commodities have done very well, and I personally think they're going to keep doing very well because inflation's going to stay sticky, and the demand for a lot of these commodities is going to continue to go up. MSCI, they released decent earnings, but they did miss revenue, and I think they lowered guidance a little bit, so that caused them to be down on the week. They came down a lot, but I immediately bought some of this company, and again, that after that they were up actually quite nice on that. So I bought below 450. Again, very small position. We're talking like probably I don't even know, it was a 0.5%. So a very solid company in my opinion, though. So again, I think that if you're buying it below $500, I think that's a solid deal where it's at. If we look at its historical valuations, it is significantly below all of them. Although honestly, it is still debatably expensive where it's at right now. So honestly, this is probably about fair value where it's at right now. If it goes above 500, I think it's definitely getting expensive, at least in my opinion here. The next one is Pepsi, again, a company I do not own, probably never will own, but again, it's still a good one to keep an eye on. They did beat earnings and revenue. Quest Diagnostics is the next one. Again, a very interesting company, one that I keep on a watch list. I don't know if I ever will own it. Again, it did release good earnings and revenue. UPS is the next one here. Again, another good example of how the economy is doing. They did beat earnings, but they missed revenue. And they actually did come down quite a bit recently. They've had quite the pullback, I think. But actually they are up a little bit from their lows. So again, a solid company, although they're not going to be one that's going to grow a lot. And I mean, if we look at its dividend, their payout ratio is over 90%. So the threat of that dividend going down is definitely a concern, and you're buying this company primarily because of the dividend. So that's why I'm not really a fan. Canadian National Railway, again, another one of my favorites. Again, I do already have like probably a 3 or 4% position in this company, so I'll probably never buy again unless we get a very steep pullback. but I think it's a very solid company. Again, they did beat earnings but missed revenue. They were still, what did they do on the week? They were down on the week, which again explains that. But again, a very solid company in my opinion. The demand is always going to be there, and again, they're an effective duopoly with CP, so that's why I like this company. CB, another insurance company here. Again, I really like insurance companies going forward, hence why I talk about a lot of them. Again, they did beat earnings and revenue. They were down a little bit on the week, so that's kind of interesting to see there. The next one is Steel Dynamics. Again, they've done pretty good this year. They did beat earnings, but they did miss revenue, which is why they're down a little bit on the week. A very good not a very good company, but a solid company in my opinion. I do have a small position in them, and I probably never will sell that because I think that the demand for their product is going to continue to go up. The next one is Visa, which is probably one of my favorite companies. I already have a solid, I think probably a 5 or a 6% allocation to Visa, so I may never buy because I don't want to allocate more than about 5 or 6% to any stock. And again, they are a very, very good company. They are a textbook example of a very good company in my opinion. Over the long run, I'm a little bit concerned about competition, but over the short to medium term, I think that again, they're an absolute no-brainer. Where they're at right now, they are below all of their historical valuations. But again, a PE of 30, a price of free cash flow of 27, a price of sales of 16, those are all debatably expensive. I would argue they're probably about fair value. But again, you are pricing in quite a bit of growth buying it where it's currently at. So I would be a little bit concerned there. I would be waiting for a pullback to get in. Another one of my favorite companies here is Amphenol, APH. They did release very good earnings and revenue. So again, they beat earnings rather nicely, and they just hit a new all-time high. They're up very, very nicely on the year. They're up. What are they up on the year? They must be up quite a bit, about 27%, which is very good to see. My cost basis on this company is about $82 a share. I think I got like 7 or 8% allocated to them, but that's mainly because they've done so well. And again, I'm up probably 50, 60% on that position. Again, I will be holding that. I'm not a fan of ever trimming a company. My idea is just don't buy any more. And eventually, when you're buying different companies, the allocation will come down a little bit over time. So again, another company that I really like, although again, it is expensive where it's at right now. So you would have to wait till it's probably 100, 105, probably around $100 a share before I would pick up more. So again, we're looking at probably roughly a 15 to 20% pullback there. LII, again, another company I have on a watch list that I will buy if you get a good price. They did beat earnings, but they missed revenue. Again, a company I really do like, but again, they're a little expensive where they're at right now. Masco, another company that I am dollar cost averaging into. They did beat earnings, but they missed revenue. I really do like this company over the long term. I think they're going to do very well. And to be frank, I think that they're a buy where it's at right now. I think you can be buying this company where it's at right now. You can't say that for probably 80 to 90% of companies out there. So that's one that I would be buying right now. ODFL, again, another company that I really, really like here. They did beat earnings and revenue, although they did release maybe not the best guidance, which caused them to come down very significantly on the week. Let's look at how they were down very significantly here. They're down about 13, 14% on the week. And I actually bought some of this company right around 183, 184, I think. And they're still debatably expensive, but this is a very, very good company, like a very good company. And I mean, the trucking industry is going to stick around, right? The demand for that is only going to go up. So I really like this company still. I think that if you're looking to get into it, I think you can get into it around here. Although I would tread carefully because they are still debatably expensive. ALGN, Align Technology. They did beat earnings and revenue. Another company that I have on a watch list, although I'm not sure if I'll ever get into it. The next one here is not AMG, Chipotle. This is another very good company. Although again, they released very, very good earnings, and I think they were up. I think they were up quite significantly on the week. Yeah, they were. Again, another company that I would get into if you got it for a good price. But again, they're still crazy expensive where they're at right now. I mean, a price of free cash flow of 71, that's just way too expensive. I don't think this company probably ever gets cheap enough for me to get into it. But again, I do have it on a watch list if they ever do. Lam Research, again, another company that I do own, but again, my positioning is already big enough that I probably won't be buying any more anytime soon. They did beat earnings, which is good to see. The next one is ROL, Rollins. Again, this is a company I have on a watch list. Earnings and per share, they're basically right on here. Again, another really solid company in my opinion. If I do get it cheap enough, I probably would take a small position here. Again, it is below its historical valuations, but those are still too expensive in my opinion to buy. So one to keep on a watch list, but again, too expensive. Waste Management, again, this is basically the pinnacle of a non-cyclical, very good company. Again, they released good earnings and revenue, but again, they're too expensive. I do have a very small position in this company, but they're too expensive. I mean, price of free cash flow of 46, PE of 36. They got to come down probably 10-20% before I would be interested here. But again, a very good company and a non-cyclical company. The next one is ALLE. Again, I am dollar cost averaging this company right now. They did beat earnings, but again, they are down year over year. Again, another company that I think you can be buying right now. A price of free cash flow of 21, a PE of 20 for a company that is growing very, very nicely. If you can pay an average market multiple for a company that's growing faster than the market, I think that's a no-brainer. So that's why I'm buying this company right now. Caterpillar. Again, they didn't release the greatest earnings. Again, they did miss revenue. They beat on earnings. They lowered their guidance, though. So again, not the best earnings report for Caterpillar, although long-term, I still think that they're a very solid company. They're going to grow. The demand for their product is going to go up. So again, I'm not concerned. I'm still dollar cost averaging Caterpillar. If we look at its valuations here, it is below its historical PE and price to free cash flow. So this is another company that I am dollar cost averaging into right now because I think it is a buy where it's at right now. The next one is Tractor Supply. Again, another company I have on a watch list. They did beat earnings and revenue. If this company gets cheap enough, I will be buying. Carlisle Company. They easily beat earnings and revenue. I do have a small position in this company, and I am actually still dollar cost averaging because, again, it is below its historical price to free cash flow, and it's basically right on its historical PE. So that's why I am currently dollar cost averaging this company. The next one is KLAC. Again, they're in the semiconductor industry. Again, they did beat earnings and revenue, although they're down year over year. This is a very good company, although it's too expensive, right? If we look at its historical, if we look at its valuations, PE of 35, price to free cash flow of 30. Those are both significantly above its historical 5-year valuation. So if we get a nice pullback in this company, I would be a buyer, but I don't know if that's going to happen anytime soon. So again, the last two are Chevron and ExxonMobil. Both of them similar stories. They beat earnings, but again, they're down year over year, obviously because oil is a little bit cheaper than it was last year at this time. So again, the oil companies, I think that they're still buys. The good ones are still buys where they're at right now. Do I own Exxon or Chevron? No, because I think that there's better options. Although, if you're not confident in your ability to pick individual stocks, buying Exxon and Chevron may not be the worst idea. If we look at their valuations here, both of them are below their historical PE and price to free cash flow. Let's look at Exxon here. similar story, although they are actually above their historical PE. So based on these numbers, it looks like Chevron's a better deal where it's at right now. But honestly, I haven't researched either of these companies I know a little bit, but not that deeply. Personally, I'm a big fan of EOG Resources is probably my favorite. And then after that, Valero I really like. And then to a lesser degree, ARLP. But my two favorites right now and my two largest positions as far as oil companies go, I do actually have three main positions. EOG is my favorite, followed by Valero. Those are my two favorites right now. So anyway, that is earnings for this week. Again, we had a very busy week. Honestly, I think that earnings season, it's looking like we're going to have a good earnings season. So the next thing to keep an eye on is that April CPI report, which will be coming out on, I think it's May 14th or 15th. So we have a couple weeks. And again, over these next couple weeks, personally, I think that the S&P will be range bound. I don't see a significant move in either direction. I think that next CPI report will drive the markets either up or down, depending on what it is. So anyway, if you liked the video, please like, subscribe, comment, all that good stuff, and stay tuned for more.